All right, folks, welcome back. Just wanted to address a question that came up, and here it is. To the famous Dave. If I do a vertical put spread and buy 29 and sell 33 and the stock goes to 28, do I capture that dollar and can I then close the position? Also trying to find where I can watch a vertical trade to see how it fluctuates daily. Okay, so I think the gentleman here kind of was sort of representing the spread backwards, but I understand what he's asking. And this is probably referring to a video I made a couple days ago. And we're talking about VXX here. So the Barclays instrument VXX, which many people use to trade the fluctuations in the VIX, the SIBO volatility index. Now, we know already that there's no direct way to trade the VIX. You have to trade VIX futures or somehow get access to the movement of VIX futures. And a lot of people will use either VXX, which is an exchange-traded product, or UVXY possibly to trade the VIX. And so I had a past video where I was discussing how to get short VXX. And in that video, I talked about how contango tends to decay VXX over time. This is due, once again, to the fact that VXX uses futures to approximate the VIX, and the futures are in such a relationship to one another that due to rebalancing of the ETP, the ETP decays over time. So you've got VXX, which we know is going to go down over time. And so what do you do? Well, it would be great to be short VXX, so as it goes down, you can make money over time. And so I discussed a put spread, which is an options trade where you buy one option and sell another. And in this way, you can sort of get short VXX and be able to make some money as VXX moves down. And generally what we do is we buy a higher strike put. So in this case, we would be buying the 33 put, and you sell a lower strike put. And in this case, we would be selling the 29 put. So let's go over to our screen here and take a look at an options screen. Actually, there's one right behind me. Let me move myself kind of out of the way here. All right, so let's see. And I generally would do one of these trades a couple months out. So let's take, for example, well, just for the sake of argument, let's take October. And so here's an October options screen. And you can see, let's see if I can actually make this screen a little bit bigger so that we can kind of see things a little bit better here. All right, so, and what I'm going to do is I'm going to highlight the markets in the put options for VXX right about now. And in this manner, we can take a look at a real options screen and what's going on here. Okay, so I'm pulling this up off screen, and then I'm going to flip it over so that you can see it. Okay, so here we go. I'm flipping it over. Boom. Okay, so the markets that you see off to my right are markets for puts in VXX in October. And the markets are closed right now, but this is what the markets were when the market closed. And we're talking about this put spread. So we would be buying the 33 put that you see off to the right. The market in the 33 put, you can see, is 605 beta at 625. Okay, so we'd be buying that put, and we'd be selling the 29 put. So in this example, you can see that you're buying something for about $6 and you're selling something for about $3. So this spread in this example is worth about $3. Does that make sense? Because you're buying something for $6, you're selling something for $3. Okay. Now, let's just talk about the principles of a spread for a second. Okay, if you are buying an option and selling another option that are $4 apart. So the strikes are $4 apart. 29 to 33 is $4. So if you subtracted 29 from 33, you get 4. Okay, so what that means is that this spread can at most be worth $4. So, and if we're buying the 33 put and we're selling the 29 put, then the spread will be worth the most if the underlying expires at 29 or below. So 29 or below, spread's worth $4. On the other end of the spectrum, if the spread ends up above 33, it's going to be worth nothing. So 33 or above, spread worth nothing. 29 or below, spread worth $4. Anywhere in between, it depends where you are. If at expiration the VXX was worth 31, then the spread would be worth $2. And you can kind of see where I get that. And it can be a little confusing because of the way option screens are. You're kind of you're looking for something to go down. So some people might like to have the 33 strike on top of the 29 strike or something. But in this case, as I said, if you kind of walk through it, then it makes sense. If at the end of expiration, the VXX is 29 or below, the spread's worth $4. If at the end it's 33 or above, spread is worth nothing. In this case, we have the spread worth about $3 because if you bought maybe slightly more, so if you bought the 33 put for $6.25 and sold the 29 put for $3, then you'd have it worth $3.25. In general, with this sort of spread, we can reasonably expect to be able to trade it sort of mid-market. So right now, if you were to look at what the actual market is, well, if you were to buy the 33 put on the bid, you pay $6.05, and if you were to sell the 29 put on the offer, you'd have $6.05 minus $3.10. So basically, the market shown by the market makers here is $2.95 bid. $6.05 minus $3.10 is $2.95 at $3.25. So the basic market for this spread would be $2.95 bid at $3.25, and you could reasonably expect to be able to purchase the spread for somewhere around, I don't know, $3.10, something like that. So let's back this screen out for a second to its normal size, and I'm going to enter an order to buy this spread. Okay, so we'll move this back to its normal size like that, and I'm going to focus in on, so what I'm going to do is I'm going to click on the offer for the 33 put, and I'm going to go back, hold my control button, and click on the bid for the 29 put, and it's going to pull up this order entry screen. And I'm actually going to enlarge the screen now so that we can see that screen. Okay. So here is the order entry screen. And, okay, so we can see here, we can't see much because my head's in the way, so let me move my head. Okay. So there you am. There you are. I'm peeking at you from the bottom of the screen. We can see here, so we're buying one of the 33 puts and we're selling one of the 29 puts. And this has the mid-market around $3.10. So what does that mean for us? That means each time we do the spread, it's going to cost us $310 plus commissions, first of all. In addition to that, and I'm going to play with where everything is once again here, just so that I'm not peeking at you from the bottom of the screen. Here we go. Okay, so if we pay $3.10 for this spread, that leaves, and the most it's worth is $4 because there's $4 between the strikes. So the most we can make on the spread is 90 cents. You see where I'm getting that? So $4 minus $3.10 is 90 cents. So, in this case, VXX is already below 29. And so all it has to do is really stay here, and you're going to make 90 cents. on this trade. So let me do some quick math here. So 90 cents is, that's over 20% on the trade. So you can make 20% on the trade if VXX just stays here until expiration. In this case, we might pick a spread that was sort of lower strike prices, but let's just stick with this example for now, because 20% isn't bad to make on a trade over a relatively short period of time, like a month or two. Right now, we were looking at October options. There's 47 days till expiration, so that's less than 2 months. You can make 22%, and all VXX has to do is stay here because it already is below 29 right now. It's 28. It went at 28.80. And as how does the spread going to move from day to day? That was the other question that the viewer had. Well, and the answer to that is, right now it's 310, even though the spread is a complete winner. And so over the next 47 days, this is slowly going to move to $4 as long as we stay below 29. If VXX goes way lower in the next couple days, then this spread will increase in what its value is. For example, if VXX goes to like 25, this spread will increase in value almost to $4. Let's take a look on our analysis page for Thinkorswim here, and let's take a look at how this spread's going to move in real time, because we can actually model that right now to see how this spread would move over the next couple days, or actually right now if VXX were to move around. So let me see if I can get my screen on a nice size that I like it and get myself out of the way. All right, so if you look over to the left of me, we have price slices for VXX, and I'm going to put the spread that we just talked about into our analysis software here. So we've got the October. I'm buying the October 33 put, like we talked about, paying $6.25, and I'm selling the 29 put for $3. So let's take a look. And what we'll do is we will enter this with a price of 310 like we talked about before. Okay. And let's do this spread 100 times. I know that's probably bigger than most people would be doing this starting out, but just as a way of illustration. All right, so I'm putting this spread in 100 times. Okay, so let's see. Or let's just do it. Let's do it 10 times. How about that? 10 times. And okay, so if we move the price down a little bit, and what we can do is we can go to the risk profile here. And this is going to show us what this will be worth at different prices. Okay, so let's see. Maybe this isn't the best way of showing it. This is going to show your P&L, but it doesn't actually show what the spread is worth. But essentially the answer to the question here is that as the stock moves down right now, if you put the spread on today, as the stock moves right now, you'll make a little money as the stock moves lower. But if we look at the delta that it's showing right now, if you should do the spread 10 times, basically it's showing a delta of 159 right here. So that essentially means that if VXX goes down $1 and you'd done this trade 10 times, you'd make $159. If it goes down $2, you'd make somewhere around $300, a little bit less than that. So if you were to just do the spread one time, if VXX went down $1, you make about $16. If VXX went down $2, you make somewhere around $25. I hope that clears up a little something. The big takeaways from actually this question, first of all, were that when I'm talking about the spread to get short, what I'm doing is I'm buying the higher strike put, the 33 put, and I'm selling the 29 put. The spread can be worth at most what's the difference between the two strikes, which in this case is $4. And for it to be worth $4, and for our analysis to the analysis of looking at it, okay, well, below 29 is worth 4, above 33 it's worth 0. That is at expiration. So if you're going to take the spread off before expiration, your profitability will be slightly less if it goes your way, and if the spread goes against you, you're not going to lose as much as you would have lost at expiration. Because as we still have time left till expiration, the fact that the stock can move back and forth around means that the spread's value is not the same as it would be once it's expired. Anyway, I hope that helps you a little bit in understanding this. I'm not sure if it completely does, but it's understanding spreads is a process of first understanding kind of like what you're doing in the spread, and then figuring out how it moves over time. And one of the best ways to understand this is to actually either paper trading or really put the spread on and watch it over a couple of days. You can do the math yourself. You can pull up the options screen and you can figure out, you could kind of say, okay, that's worth about 610. If the 29 puts, the bid is 3 bid at 320, you could say, okay, well, that put's worth about 310. And so the spread's trading around $3 right now. Then if UVXY goes, or VXX goes down $1, maybe the spread is trading 325. And in that regard, in that way, you can watch the spread over a couple days, couple weeks, and see kind of how it trades, and kind of get a little more comfortable with what kind of parameters you're dealing with. And what I do commend the person who is asking this question about is they are interested in checking out this trade and seeing how it actually trades over time before they jump in on it. And I think that's a great idea. With options, it can be a little bit confusing at first, and that's true for everybody. It was true for me. So if you are feeling a little confused at first, that's normal. It takes a little time to get used to, and that's normal. It happens with everybody. It happened with me. If you work at it a little bit, though, things will click in for you, I guarantee, and you'll understand a little bit better. So stick with it a little bit. It's definitely worth it. Spreads like this are a great way to trade the VIX and volatility because, for one thing, you know how much you can lose. If you pay $2 for a spread, that's $200 each time. The most you can lose is that $200, and that's good to know because you're not going to be putting yourself in a situation where you're trading a stock on margin and they're calling you with a brokerage saying, okay, you have to sell now because your margin is you've run out of margin. And the spread allows you to capture a relatively small down move. You can make some real money on. So it's a good way to trade it, and I commend everybody actually on getting out of your comfort zone and learning something new. So stick with it. You're doing the right thing, and I will continue to clarify and put out more videos to try to help clarify this for you. Thanks everybody for watching today. It's just a short one. We have a holiday tomorrow, so don't think about the market tomorrow. Go enjoy your holiday, and we can come back and be fresh on Tuesday. Thanks for watching, and I'll see you again soon.
When we ride, it's till the day that you die.